G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David. I run a mortgage broking business called Atelier Wealth, where we specialise in helping property investors start out, scale up their property portfolios, and we are on a very clear mission to help create more property millionaires to build intergenerational wealth through property. And along this journey, we want to kind of fill your ears and your head and build up that knowledge cup for you by bringing in experts that are qualified, licensed, to share what they do, but also share what they've done for their clients to help you on your journey with your property aspirations as well. So on today's show, we've got Moxin Reza. Welcome on, Moss. How you doing? I'll call you Moss straight away off the bat, nickname. G'day,
Aaron.
Moss. How you doing?
I am awesome, Aaron. How are you today?
I'm doing great. Thanks. So Investor Partner Group is the business. You've got the group that I've seen is Help Me Buy, and we'll focus on that. So take me through and we'll kind of kick off into the 3 Ps about yourself personally, professionally, and your property journey in a second. But just for the listeners, take us through, I guess, how your business is structured and who you are, Moss.
Sure. Yeah. Let me kick off about me, myself first. So I try to call myself an everyday average Australian. I don't classify myself, someone who is out of reach, a dedicated husband, a son, a father, a property mentor, definitely a serial investor, but a data scientist or data nerd at heart. And so
my data scientists are the new rock stars.
Yes, definitely. Definitely. Investor Partner Group is basically the parent company of Help Me brand. Yeah. And what we are trying to create is basically Help Me brand in relation to Help Me Buy, Help Me Sell, Help Me Rent, Help Me Develop, Help Me Renovate, all of these sub-brands in typically following the dream of creating sustainable and scalable property portfolios without impacting or sacrificing lifestyle. Ultimately, if you think about this, you go back to that conventional methodology around, okay, I want to buy a property and I'm going to pay this off till I retire and that becomes my retirement. I'm of that opinion that there is a better way to do this. There is a better way where you can improve your lifestyle along the way. You don't have to wait for that D-Day to happen in order to basically use that property portfolio towards your retirement. And that's the mission. That's how we basically grow.
Yeah. Okay. I mean, your approach isn't, and I mean this with all due respect, it's not revolutionary. I guess you've just articulated it very well, right? Because you think about buying property, there's the buy and hold strategy. There's the buy, renovate, revalue, pull the equity out, go and buy the next property to scale up. There's the buy and trade, so buy and sell and try and trade properties effectively. And then there's the buy, develop, sell, buy, develop, hold. So I guess you've got without overcomplicating it, you've probably got about maybe 5 or 6, maybe 7 different property strategies here that kind of boil down to, are you effectively going to buy and try and hold on to it to get the cash flow, or are you going to buy and sell cash out to then, get a higher return on that cash on cash investment as well, right?
Definitely. And I think people believe that it's a single way of thinking about this. It's not true. Everyone follows their own strategy.
Yeah.
And none of these strategies are wrong. Ultimately, your cash flow, your risk appetite, and your ambitions are going to dictate and define what strategy you're going to follow. And at different parts of the life, your strategy is going to evolve. And that's where we come into the picture. The first thing that you need to really look at is, okay, where are you going to start off your property investment journey? How are you going to excel and evolve your property investment journey from a buy and hold mentality to buy and renovate, to buy and develop, to become a high net wealth investor where, typically you are only thinking about cash on cash returns and you don't want that market gamble to come in and, provide that growth to you. A lot of first-time investors basically want that growth coming back to them, whereas as an experienced or a high net worth investor, you take that gamble out completely. And so how do you go from that point A to point, B, point C, point D, using your own risk appetite, using your own financials? And that's where a lot of this story pans out, So I truly believe there is no single answer to this strategy. I always use this as an example that everyone's strategy is a fingerprint. You can't replicate it. You have a different mindset to it. You would have a different risk appetite to it. You are on different levels of income. You have different financial commitments, you have different family commitments. And so why would you follow someone else? You need to define your own strategy and follow that.
I love it. Hey, mate, well, so that's really well articulated, which is, that's unique to you. And that's what we say, everyone, you can't compare your starting journey to someone else's finishing journey as well.
100%.
It's unfair to then, play that comparison game. Mate, if we kind of go back a step, take us through. I mean, you came to Australia, I believe, when you were 18. So to come in for to this country at 18 and to, I guess, effectively build what you have in this short space of time, real testament to kind of your ticker and to your resilience as well, mate. Well done.
Yes, thank you. Look, I am super blessed and super humbled. I've assisted over 10,000 people to date in achieving their, property dreams, or, what I call them is, that financial independent lifestyle, right? Typically, when people think about their retirement, or when people think about, financial independence or financial freedom, they always think that there is this D-Day in the future that is going to happen, and they're planning for that D-Day to happen. I always say that retirement is a transition. Your financial independence does not mean that you're not working. Financial independence means that you have a choice to do whatever you want.
Yeah.
And if that choice means that you work and you love what you're doing, then that's fine. There's nothing wrong with that. I use this example with one of my clients where I said to them, you're walking on the road, Melbourne, Collins Street, you see a Louis Vuitton store, you walk in there, you buy a $10,000 purse, you walk out without even blinking, without even thinking about the financial complications or the financial implications about it, because you can, right? Because it's your choice, because you know that your portfolio is strong enough for you to go out and, make that lifestyle choice at any given point in time. And that's the financial independence that you want to. It's not so much about, hey, I'm debt free. Well, debt is great. If you can manage your debt to a great level, then it's perfect. And so if I take you back through sort of my own journey, it was never about, getting rich. I always say this to people that, it's not about number of properties. It's not about, getting there quick. It's about, sharing the experience and sharing the mistakes. Look, I mean, I'm here today because I've made every mistake under the sun, and I'm proud to admit it, right?
You and me both, my friend. You and me both.
Yes.
Take us through. Give us an example of a mistake that you think, if you could, not that you'd rewind time because you learned from it, but give us a couple of examples.
Look, the important thing with the mistakes, and I'm happy to share the mistakes. You talk about off the plan properties. You talk about end-risk properties. You've done them all, right? Bought the wrong property at the wrong time, bought the wrong property in the wrong location. All of these mistakes I've made, in my life. The important thing was that I was brave enough to identify that mistake and fix it as quick as possible. A lot of investors basically do not have that mindset of treating property as a business. And so they set and forget. They buy and think that, there is too much of a transactional cost. I don't want to sell it. Fingers crossed one day this property is going to perform. It's like, hiring an employee that's not performing and then, praying to the gods that this employee is going to perform one day magically, right? And the reason we are here talking about our property portfolio is basically we were brave enough to go back and remediate, right? And that's what I say to people, if you bought a dud, it's okay, right? Go back in and fix it, if you're trying to do it yourself. And so I was no different, when I started off my, own property journey, working long hours, multiple jobs, doing everything to, keeping the property portfolio afloat. I remember when I started, interest rates were at 8.9%, almost like 9%. I fixed my properties at around 8%. I still remember that, because I was panicking as to, okay, the interest rate is going to go higher and higher, right? And so that feeling of, being overwhelmed, exhausted, desperate, unhappy, all of that were there, on good income, by the way, right? And on paper, you are super rich, but you are significantly cash poor. And so you're thinking about that extra coffee and what is that going to do to your bank account? And, money comes in, but money walks out of the door, basically, right? And so you basically every morning you suck up and pay those bills, and it's awful, it's stressful, and you feel super stuck. How do you come out of this was basically where, the story is. And so I still remember, I was one property away from, hearing the bank saying big fat no to me, sacrifice my work-life balance completely, doing 3 jobs, making sure that, I can service these loans, thinking about, okay, how do I, buy the next property? And by no calculated move, I picked a property in Reservoir in Melbourne that I ended up developing in 1.5 year time because I met one of my directors then. And again, this was a complete fluke. I had no idea that this property could be developed. I bought it and then realized that, I can save the house at the front, build two at the back. I bought that property for 680, subdivided it, sold the front at around 595, built two houses at the back for around 550 at that time, sold each one of them at 720. And so made a killer. And I realized, and that was a light bulb moment for me, that, okay, properties with multiple exit strategies are something that would basically help you scale up and move up in the value chain quite quickly. And I basically revamped my whole property portfolio from 2014 onwards. I say to people that I hit a reset. That's exactly what I did. I hit a reset. I sold, bought, changed the asset classes completely from 2014 to 2018 quite aggressively from my property portfolio, realizing that, okay, this is how I need to do it. And this is the way of, setting up the property portfolio, right?
How did you kind of hit pause and go, I'm going to rewire the way that my portfolio's? That's a dramatic shift or a pivot, for example. What was the penny drop moment for you there, Moss?
Well, it was basically that first development that I did. And I realized that, all these properties that I'm holding do not serve the purpose. I don't have a long-term view of what I'm going to do with these properties. Some of these properties have given me the growth that I desire. And so why are they sitting in my property portfolio at all? Made no sense to me. So from my perspective, the property portfolio needs to keep growing and keep scaling. And how do I go out and create more income for myself from a property portfolio, creating that sustainability that a lot of developers, a lot of, property buyers fail to create for themselves. And so, right now, if you look at my property portfolio, bringing in close to about $250,000 in passive income, almost 60 million in net wealth, you're talking about $50 million in developments, all of that has happened literally because I've hit that reset button in 2014. Now, mind you, that property was still a selfish passion then. I wasn't help me buy brand CEO, right? This was still in the making. So, yeah.
Oh, it's an interesting journey. Thanks very much for sharing. You mentioned other mistakes. There's some of the things that you've kind of taken in your stride. The property, the development site obviously gave you a good springboard. What else do you think has worked very well for you to help scale up?
Look, two most important things. One is treating property as a business, and two, ensuring that it's always an evidence-based decision. Treating property as a business basically provides you that flexibility and agility to make decisions as quick and in a very agile fashion. And so what you're doing is you're looking at your property portfolio in a much more proactive sense. You're looking at it, you're assessing it every 6 months, making sure it's doing what it's supposed to do, it's going in the right direction. You're assessing every property. And basically that's what you would do with your business, right? You would have touch points, you would have milestones that you would want to achieve. And so treating property investment journey as a business was basically an eye-opener from my perspective. You are more proactive rather than you're more reactive. You're not an opportunistic investor waiting for COVID to happen, waiting for GFC to happen. You are basically out there knowing that there's markets within markets and you can play those markets, come out cleaner and bigger every time. And so that was one thing. That second thing, which has helped me excel quite significantly, is evidence-based investing. And so non-emotional evidence-based investing is the key. One of the rule of thumb that I used to follow all the time was do the opposite to what the media is telling you to do, because the media is there to entertain. They are not there to educate, right? And so, and I for people who don't follow data as religiously as we do, right? Typically understand that media is always looking at a rear view mirror. They don't have the predictive analysis to tell you where the story is. And a lot of people fall into this fallacy, right? You talk about hotspots. You talk about, hey, these are the suburbs that are doing really well. Well, they're telling you they're doing really well because they've already done really well, right? They are looking at the indicators right now as to, okay, there are X amount of people buying there. There is X amount of growth happening there. The past growth is not an indicator of future growth. And, that was the biggest sort of indicator from my perspective that, okay, you don't need to follow what the media is doing. What you need to do is create your own evidences, make sure that, you're not going into the self-serving bias, and then invest unemotionally.
Hey, thanks very much. I think when we touched on earlier about buyer strategies, so you got the buy and hold, you got the buy and develop, for example, and you're saying like everyone's got their own unique journey. How are you advising people? And I mean, you've got inside there, you've got NDIS, you've got SMSFs, for example, as well. So with a whole suite of options for people, sometimes are they coming to you going, Moss, I'm a little bit overwhelmed. There's too many options, for example, or are you just going, I think this is the next best step for you, to talk them through their wealth journey as well? What does that look like?
Typically, every time a person comes to me and they are of a single-minded mentality that, okay, I want to buy X or I want to buy Y, I always, be the devil's advocate and ask them why, like, why this and why not that, or why not this, right? Because ultimately, from my perspective, we are the non-biased advisors, right? So I'd be like, well, let's take a step back and understand or financially model your lifestyle. Let's do that. Let's understand as to where you are right now. Where do you want to be in 5, 10, 15, 20 years? Actually financially model your life, and then use property as a vehicle to basically dictate as to where you want to get to. Your outcomes and the desires are going to replicate into your risk appetite, and that is going to dictate what your property portfolio needs right now. And so a lot of people would come to me and say, hey, I want to buy another negatively gated property, for example, and be like, well, no, your property needs cash flow. And so why are you going down the path of buying another, negatively gated property, right? And so those answers becomes automatically evident. You don't have to do anything different, right? All you do is just lay down the life for them and say, okay, if you do what you're doing right now and keep doing this, this is how negative you would be. A lot of people don't realize how much money they're losing on a day-to-day basis because, they don't have that holistic view of the property portfolio. And that is what basically dictates and defines as to how is their property portfolio going to evolve over a period of 2, 5, 10, 15 years, right?
Yeah.
I have this few method where I talk about, foundational investing to expedition investing to high net worth investing, or this journey from first time investor to, high net worth investor. How do you take that journey? What key decision points do we need to do? What sort of returns do you need to aim for? What sort of targets do you need to achieve? And this is like all of that business mentality, right?
So take
if
us
you are
through,
giving your portfolio a target,
yeah,
then it becomes so much easier to go in that direction. And that's why, every time a person comes, you can look at their property portfolio and say, okay, this is where the gaps are. This is what needs to go. This is what you need to keep. Yeah. And this is the direction that you need to take.
So you probably have that. And I think I want to go back to what you mentioned about, early investing versus high net worth investing, for example. What is the big point of difference there that you see? Is it a mindset thing or is it a portfolio value?
Look, I mean, typically as a first-time investor, your biggest problem always is cash, right? So when you're going to start off in the investment journey, understand that as an average investor, for you to save a deposit, it takes about 2.5 to 3 years. Okay, I'm talking about normal mom and dad investors who are on $150,000 combined household income, right? And so if it's taking you 2.5 years to come up with a deposit, that means that you purchase a property today, it's going to take you another 2.5, 3 years to basically come up with the next deposit. And so your natural focus needs to be that you provide buffers in your property portfolio, number one. Number two, you aim for short-term growth, because that property that you've acquired for 500, if it grows by 15% over the next 15 months, you have the next deposit ready, right? Yeah. And so typically that's the scalable nature of the property portfolio. A lot of the people, what they do is they start off in the wrong direction. And so they'll start off with a negatively gated property, or they'll think about, starting off with NDIS properties, for example, or high cash flow property. It serves the purpose of bringing in extra cash flow into the property portfolio, but the chunky problem of having that cash or the deposit does not get solved, right? And so that's why they're stuck. Yeah. And so it's important that where do you start your journey as an investor and then climb up from there? I always say to people, like being a developer is such a cool thing, right? Everyone wants to be a developer.
Everyone loves it, yes,
right?
Yeah.
But you understand that you cannot start your property journey from a development, no matter how much serviceability you have, right? You cannot, because the biggest problem with development is cash flow. And so if you don't have the cash flow, you will get stuck. And so it's not somewhere where you would start off your property journey. You would build up the capacity to do developments by holding properties on multiple exit strategies and solving the cash flows issues in your property portfolio before you step into the development space. Again, it's a methodological approach of, chasing growth and yield at the start to chasing growth and manufacture returns in inexperienced scenarios. And then as a high net worth investor, you only focus on yield and manufacture returns. You don't really care about growth, right? As a high net worth investor myself, for example, I don't care whether it's GFC, whether it's high inflation, whether it's COVID. My cash needs to deliver 20% return to me every year, regardless of whatever the market is doing, right? And that's how you progress from a passive investment strategy to an active investment strategy.
Yeah, thanks very much. I really appreciate you kind of sharing and clarifying that, mate, because I feel people listening going, everyone wants to be a high net worth individual, right? There's aspirations, and that's certainly ambitious as well. But then I feel like the shift in mindset, because I talk to a lot of clients, I'm like, you're dreaming big, but you're playing a small game. Like there's
100%.
It's not matching here. So what you want to do, but what your risk appetite isn't aligned here. And I think we've all been guilty of that at some point in our life. And you even see it probably from an age perspective. Like we've got younger clients who have risk because they've got time on their side, so they've got a really strong risk appetite, but they don't have the means or the ability. And as we go later in life, I'll pick out a number, someone in their 50s, they've got really good means and ability to springboard their wealth, but now their risk has kind of dimmed down because they're coming to a time in their life where a bad decision may set them too far back, but a good decision can propel them even further as well.
Definitely 100%. I completely agree. I think people have this massive mismatch of where their risk appetite is versus where their financial wealth is, and I think that's what creates a lot of disparity, right? I have a client who came to me when he was 35. And when I did the strategy session with him, he said he wants to retire by 40. And I was like, oh, okay. So 5 years down the track, that sounds great. And he was sitting on a lot of equity, but his risk appetite was significantly low. And I was like, you can't tell me that you want to retire in 5 years' time, creating a passive income of $300,000 with a net wealth of 10 million, with one property on hand, which has, yes, $500,000 in, equity growth, but with zero risk appetite. You can't, it's impossible, right? I don't have a magic wand to basically take you there, right? Yeah. If you want to retire over the next 5 years, you need to have a higher risk appetite in order to basically take you there, right? And so there is this massive mismatch. And so that's why laying it out as a financial model for them basically opens up their eyes that, okay, if they make these aggressive decisions, they get there. If they don't make these aggressive decisions, this is how the property portfolio takes, right? I think there's a lot of this fake economy created around, I call them, property prophets or property gurus where, retire in 3 years or retire in 5 years.
I'll tell you where the next hotspot is to buy.
Yes. Yeah. And I say to people, look, this is not a get rich quick scheme. Like an average investor to go from first time investing to high net worth investing, I have never seen that cycle achieve in less than 7.5 years, right? I completely ignore what COVID did because COVID was a one-off event. This was nothing out of, it was extremely extraordinary.
Not predicted.
That's not how property markets operate. And so any property profits who are out there thinking that, you can, double your property portfolio in 2 years. Look at the 10 years, 20 years data, 30 years data. This is not this is not Crown Casino or Star Casino where you put it on the red and, get 3 times the value. This is not how it works, right?
I guess I want to touch on a separate issue. I recently went to the PIPA conference, for example, and they spoke about the housing shortage. And I guess more recently there was talk, I think it's about 600,000 properties in Australia could be slated for say a granny flat. And you're down in Melbourne, right? So you're probably seeing, just like we're in Sydney, the influx of say new migrants, for example, is putting pressure because, rental crisis, the yields are strong as an investor, but if you're a renter, you're up the creek without a paddle at the moment. So what are your thoughts if you kind of zoom out in the market and go, okay, what are some ways that we can tackle the housing shortage or the housing crisis and the rental crisis that we have at the moment? Do you think, Moss?
Definitely. Look, granny flats are definitely high up on that food chain, right? And if you think about granny flats, everyone has their backyard and they can build a granny flat at the back. Where I sort of slightly disagree is that from a manufactured equity perspective, granny flats do not do justice. And so in average as of today, for example, and this is me talking from an investor perspective, from a rental pricing perspective, of course, granny makes a lot more sense, right? But as from an investor perspective, if a granny is costing you $150,000 to build, and yes, you're generating an extra $300 or $350 per week in rental coming out from the granny, your house value does not grow up by the same amount that you are investing in the granny for. I'll use this as an example. Your house is say worth 500, you put a granny for 150, your house does not become 650 automatically. It actually probably as a valuer would come out with the granny flat would probably value it more around 600. And that's where my sort of, thinking goes that, you're locking in a lot of equity by building these overpriced granny flats. Where the difference of opinion basically takes me is these, built home, kit homes, flat pack builds, where, that's a massive market, right? I was talking to a client the other day where, we are testing it out on a few of our clients' portfolios where a granny is literally costing about $35,000 to $40,000, right? Instead of 150. Now it makes a lot more sense, to put a granny at the back and basically create that extra income for yourself. So that's number one. Number two, from an affordable housing perspective, it's not just about one-on-one relationship. What COVID has really taught us is that ultimately humans or peoples or tenants like to live with other humans. It's not so much like isolation was a killer for a lot of people, right?
Yeah.
And my view of the world is that, especially from an immigrant's perspective, when you talk about, single immigrants, students, you're talking about people who are just coming in individually, like myself. The affordable housing solution is typically, multi-units, co-units, or, rooming house accommodations, where you're not talking about, rundown student accommodation or boarding houses. You're talking about high-end, fully serviced apartments or, co-units or multi-units where you're providing all the facilities to these people. You're giving them an opportunity to live in better areas, in good states, with all the, bells and whistles within the house. And that's a win-win scenario for everyone. You're providing a win for affordable housing. You're providing a win for a client who is basically buying that property. You're providing a win to the banks as well, typically. And, industry from a build perspective, where you're building these to that level, to that advantage that, you're scaling up and, using this to scale it up to 600,000 or 500,000 homes that are predominantly required right now to, upfill. So,
I guess further to that, you got the government that's kind of put out the mandate that they want to see 1.5 million properties, built over the next few years. And we're nowhere near that. I was listening to, an interview, I think with Mark Boris as well, and Tom Panos talking about, developers there's no margin. I mean, we've got developer clients. I know you guys are developing at the moment. So developer margins, how are you guys building in or baking in some margin at the moment, given that it's so tight to have that builder margin there, Moss?
Look, it is getting tighter and tighter. I think right now, the biggest problem is not the influx of immigrants. The biggest problem is the shortage of supply that no one is putting a key eye to. I know none of my developer friends, and I have a massive circle of developers who would usually do 4 to 5 developments at a given point in time, are not doing anything at all, because the builders are scared, and so their margins have hit through the roof. So they are charging 20 to 25% margins on their build contracts because they don't know where the market is. The labor shortages are not really helping, and the prices of the build hasn't been reflected into the resales of the value. And so the builder is like, okay, I'm paying a higher interest rate, I'm paying a higher build price, but the resales hasn't changed. And so my margins are super, super thin. And so why would I develop? I'll just hold. Which means that this shortage of supply is going to be tenfold, because this supply shortage cannot be fixed over time. It is something that would require at least 2 to 3 years of lag for people to basically come in and do the build and get it through the planning process, etc. Right? A lot of the developers are basically sitting on the stock, doing nothing at all. Like, I'll give you an example for one of our projects where we are the only developer doing the development in the whole suburb, but there is nothing else being developed in some of these areas at all. And so I think that's a bigger problem, right? Because if the developers are not there developing, the interest rates are high, even single homes are not being built by normal investors.
Yes.
And, the government is saying build more. Like, where are the people going to go when, the market is contracting quite significantly? So that one-on-one relationship doesn't work. Like, you can't assume that, there would be one person living per house. I think it's more about either smaller housing, higher densities, smaller units, or co-units or multi-units. Basically that's where the market is going to head towards.
Yeah, nice. It's an interesting perspective. I mean, that's something that hasn't probably been floated as a mainstream idea. We just like build more apartments, higher density in these hotspots near infrastructure. But I don't think it's really solving the broader problem at the moment, which is we've got a shortage on supply. Yeah, correct, mate. Perfect. Now, I know, Moss, you've got a fairly active Facebook group and a good community. So how can people get in touch or be part of the community as well?
Yeah, definitely. Look, we run an active open community. It's called Property Investment Australia. I have my book coming out. It's called Millennials Way of Property Investing, where
fantastic.
I've talked about every stuff up that I've made under the sun. Everyone talks about what to do in property investment. No one talks about what not to do. And I think that list is quite small fundamentally.
I think it's also a fair amount of humility going, I've made some mistakes. And no one wants to talk about the mistakes they've made sometimes, right?
Yes, 100%. So look, join our Facebook group. It's called Property Investment Australia. It's sitting at about 6,500 people. A lot of those people are either our clients, ultimately we are trying to create a community of, investors who are at different stages of their life cycle and help each other basically grow. Understand that property market is so much more diverse right now. It's moved so much away from off the plan properties and, house and land packages. There is so much happening in property investment space right now. So be part of the community, please join in and help us, create sustainable property portfolios.
Beautiful. I love it, mate. Thanks very much. We'll include the details for Help Me group as well. So if anyone's interested in finding out more about what you guys do and how you do it, we'll include the details there as well. So also thank you very much for sharing your experience, your expertise, and also your knowledge, mate. It's been a pleasure.
Thank you, Aaron, for having me on the show. It was wonderful.
Look forward to your book coming out. We might even do a book giveaway once that comes out.
Yes,
on shelves as well. That's exciting. Good luck with the launch. Listeners, if you found that helpful, leave us a review, or even better, drop us a message if you found that really useful. And we love hearing from our listeners, which we're getting more and more of as time goes on. So I want to say thank you very much for your time, for lending us your ears as well. And until next time, take care.